Today is September 23rd. It is 4:43 p.m. Eastern Standard Time. This is a Clueless8 market update webinar, after market update, and this session has been recorded. Full disclosure: this is purely for educational purposes and not for any solicitation or advice. So let's start off. Let me just make a couple of very important comments, that observations and things that I have seen, that I experience, and I'm sure all of you do. This is an extremely volatile market. You've heard me say that 1,000 times, but I mean that more. There are lots of mixed signals in the market. There are bearish signals, there are bullish signals. Depending on the time frame you look at, you're getting a different point of view. There is a fundamental difference between intraday volatility and what's going to happen 2 months from now. The first question you have to ask yourselves is, are you looking ahead into October, November, or are you looking at what's going to happen over the next 15 minutes, over the next 30 minutes, or over the next one day, over the next 24 hours? I do my best every single day to give you a unbiased opinion on what I think is going on out there. And even myself cannot predict what's going to happen over an hourly basis or a 15-minute basis. Today alone is a prime example of intense volatility. Markets closed down 50 points, which is pretty much a right on the halfway point. Does that mean that everything is doomed for tomorrow? No. Does it mean that we can test the lows, as I've been talking about, that I'm going to show very clearly today, of 1900, if not 1920 on the S&P 500? Absolutely yes. That's the reason for keeping hedges in place, despite the fact that the hedges during the day were positive at one point. And depending on who did what, it's up to them to take some profits and leave some alone. And the ones which were left, the balance that was left, was somewhat in the red, which is not a problem with me, because I've mentioned this before and I'll say it again. You cannot expect everything, especially when you're on both sides of the equation, both long and short. And the hedges normally are on the percentage-wise should be on the smaller side, given the fact that the markets are basing right now, depending on what somebody feels. You cannot expect everything to be green. It doesn't work like that. Here's an analogy that I thought to myself in this afternoon. You ever try to catch a bouncing ball that's bigger than you? I know what the answer is: no. And if you try doing that, then you're truly insane, which is good. That's fine. Insanity is great for trading. So if you ever try to catch a bouncing ball that's bigger than you, you're going to have a tough time managing it. That is the nature of volatility. We have macro forces that are at play right now, which are far bigger than what we are doing here on the trading side or the investment side. I want everyone to understand that clearly. I'm saying this is simple English. We have macro global economic forces that are in play right now, both on the currency side, on the economic, on the financial market side, that are bigger than us. It does not mean it's good or bad. It simply means that market players, which are purely dominated by machines, are day trading the markets very rapidly. Can somebody mute their microphone, because I'm getting a lot of feedback? Okay, I'm going to mute everybody. Okay, that's better. Can everyone still hear me? Okay, good. Thank you, Nia. Um, so what it comes down to it, and this is something key about trading and about investments, but mostly about trading because we're talking about short-term, much shorter time frames, is you have to have a conviction based on what you see. People tell me I'm following your charts. Absolutely, you're following my charts. But do I control the market? I don't even control my own trades. So the bottom line is you have to look at that. You have to go with your gut feeling of what you're feeling on what's happening with the overall environment. And then you have to make a decision. You don't have to pull your whole pile of cash directly in the market one way or another. We're in an uncertain market right now where I know exactly what the levels are. I just don't know exactly when they're going to get hit. I also know very well that the markets, and this is the good news, that on a weekly and a daily basis are starting to base. Now, what does that mean? It simply means they're trying to find a bottom that they can bounce off from. Therein lies the essence of volatility. The other thing I want to warn everyone on is these machines that run the market are constantly giving out false signals because they have only one motive. And that motive is to basically go ahead and destroy whatever positions you have at any given time because they know very well, based on past experience and based on trades that have been executed. That's how these, it's called machine learning. Want to know what that means? Just Google it. Intelligent machines, they know very well at what point you're going to croak. Now, what does croak mean? That's a very technical term, right? At what point you're just going to get so scared that you're going to get out of that position. Now, that's both short and long. And today was a prime example. We were down 120 points or something. Then we went almost positive, and then we ended down 50, somewhere in the middle. So they know very well that if they keep traders and confused, and the traders can be institutional traders too. Remember, the machines are in the business of hurting and moving around and giving false signals all over the place. So, coming down to it, before I get into the charts, you have to keep in mind that there is no easy answer. Everybody wants an easy answer. When you go to your tax accountant, when you go to your doctor, you always want an easy answer. What can I do to make myself better? What can I do to pay less taxes? Well, sometimes there are no easy answers. This is one of the times where there is no easy answer. So I'll go ahead and basically point out the levels I'm looking at, and then you'll take the ball. Hopefully the ball is smaller than you, so you can basically, when it bounces around, you can manage it. And you take that bouncing ball and you're going to run with it. That's it. So let's starting off with the bearish scenario, which is the UVXY. Here is a picture of the UVXY, and here is what I have on the charts. Now, if you're not studying my charts, if you're not taking the group sessions, you're not really fully understanding the meaning of these charts, then there is no one to blame other than you. That's all I have to say. Because even after the group sessions, even after you understand all the mechanics of how these things work, you have to keep in mind that I do not control the market. And if I did, I'd be charging you guys 20,000 a month in order to do it, right? That's just the way it goes. So here's a picture of the UVS. I have a very large falling wedge. This green line here. Let me get my drawing tool. This one is a very large falling wedge, and it's broken out of the wedge. So that's a negative. Remember, this is a inverse correlation to the market, right? This is the VIX ETF. Inverse, I'm trying to write this with my mouse. It's very hard, but I am trying. Okay, inverse correlation. So it's broken out of this large falling wedge, this large one right here. You don't know what a falling wedge is? Well, in that case, what can I say? You really have to not just take my group sessions, but you need to really, educate yourself a little bit more. So in between that, we have a somewhat of an ascending triangle. This one we're looking at, okay? And this is what it did today. It got up there towards the 56 level, pulled back, and created a bull flag. That's how I'm reading it. It's created a bull flag. It's getting oversold. What does that mean? Because I rely on the stochastics to about 70% of my readings on what the market or stocks are going to do. They're very reliable. They're difficult to read in volatile markets, but they're very reliable. Just because something gets oversold doesn't mean it's going to bounce, but generally speaking, that is the case. So what is this telling me? It's telling me we'll probably have a slightly up open tomorrow, and then this thing is going to bounce. And when it bounces up to the overbought level again, that means this bull flag or consolidation triangle is going to go like this. The net point is that at one point we are going to get to 60. This pattern is completely negated on the UVXY, which should be used as a proxy, whether you trade it or not. If we fall below, let's say 44, and we break this uptrend line from the 24 level. At that point, we're looking at the UVX coming down and testing the 30s, period. But till that happens, let me move these lines. Till that happens, the short-term scenario is telling me that over the next couple of days, I don't know when exactly, maybe tomorrow, we are going to basically get up here. It's going to be a fast move, just the way this was a fast move. This will be replicated. This is the point where there's a gap here. That's the reason why I put this. I'm not just drawing lines for the fun of it. This is the gap that the UVXY will complete, this pattern. Once it completes this pattern, it's a cup. It's going to create a consolidation handle, which is known as a consolidate. It's called a cup and handle. And then from that point, whether the cup and handle comes all the way down here, I don't know. And from that point, it'll try to attempt to move up again. In other words, this is telling us that the market is not done yet in creating a real tradable bottom. So that brings me to a picture of the actual market. Right here, the SPYs. This is a 1-hour chart. I'm going to show you different time frames, and you'll see why it's different on different time frames. I've said this many, many times before. So what it's telling me, this market is not done going down yet. So look what happened today. There's a lot of different things going on here. First of all, there's a large triangle right there, and from the October 24th lows right here. Okay, so that's a triangle. There is another line here that I drew, which is from the October 25th lows right here. And I tried to join these lines. I'm sorry, they're a little bit displaced. Let me try to get this line straightened out. That's much better. Okay, there you go. And just not to confuse anyone, I'm going to put this line under a different color. How about I put it in blue? Okay, that's better. All right, so this line is in blue. So all these are in play. These are, believe it or not, these are the lines and these are the levels that the algo HFT programs are operating in. Okay? And that's the reason why whichever lines I draw, downside or upside, they have a 90% direct hit ratio. And it's a fact. So if you were mechanical robots, you'd be hitting each one of those points on the upside and the downside. But the thing that keeps us from doing that, and it happens to me too, is our emotional instability when we are trading or investing. Because we're looking at numbers and we're saying, wow, it's green, we got to buy it. Wow, it's red, we got to sell it. It doesn't work like that. I don't have an easy answer how you're going to control that, but you need to do it. So saying all that, let me just walk you through the S&P chart. If somebody's not understanding this chart, for God's sake, join the group sessions Saturday mornings primarily, and then sometimes Sunday evenings, depending on the head count. And if you're not doing it because you're trying to save a minute amount of money, when rest assured that you will lose a lot more thanks to what the market is doing. Just letting you guys know that. So that's it. That's my take on it. So you have this uptrend line here that goes up to 206, and then there's a big gap here. This is a gap right there, which is going to get filled right here. Whether it's going to get filled in September, whether it's going to get filled in October, I don't know yet. Given the distance from here, where we are 193, that's roughly about 1938 or 1939 in the S&P, up to let's say 2040 on the sorry, I need to just check, put something here on my other screen. Hold on. Okay, so from here all the way here, this pattern will get completed. It's not going to get completed in a straight line, that's for sure, because there's a lot of things in the middle that you have to understand that is going to keep it from doing that right away. Let me show you the upside first. We have a 50-day, the red line. We have a 34-day, the orange line. I have an arrow here. Why do I have the arrow here? This is a downward sloping 34-day moving average. This is an hourly chart, but still, it's a 34 simple moving average. So this will act as resistance. It's the same resistance as closing the upper gap right here. Not that difficult to understand. This is a gap. The market at one point, the market closed the lower gap yesterday, then gave in. Today it attempted and failed. This is a channel that I drew to show what the what the lower end of the channel is. The lower end of the channel is 187. That's around 1860, 1870 on the SPY. That was the lows from August 25th, when everybody, excuse my French, was shit scared and wouldn't even touch the market. And we bought. At least I did. And it was a huge win. So that's the worst case scenario. A worser case scenario, I just made up a word, is testing the August 24th lows. A lot of bears want that. A lot of hardcore bears want the market to test 182. Is it going to happen? It can. On the short-term side, what I am looking at, because I'm not a dogmatic bear, I still believe the market has enough juice to move forward, not to make new highs, but to move forward. And I've said this many times, is this green line here, which is the downward sloping. Remember, the slope is downward. The waves are sloping down. You can see that clearly. Downwards, and more that we stay in this range, the more this line is going to slope downwards. Is to basically test 192 or 191, if not 190, this level on the S&P 500. That can happen in an hour, it can happen in a day, or it can happen in 15 minutes. That's the purpose of me keeping a hedge in the form of SPY and SPX puts. I hope that's clear with everyone. So it doesn't matter that on intraday basis that I'm in the red after selling a bunch of them when it was positive, still kept a bunch of them in the red and cost averaging down and all that stuff that I do. Because I am convicted, right or wrong, could be dead wrong, and the market takes off and doesn't look back and never looks at 190 in the S&P. Great, I have my longs. That's fantastic. The Facebooks and a whole bunch of other ones that I have bits and pieces that are long on the trading book. Not to mention the swings, which I'm keeping. The IMPV, the PayPals, the Junos, and things like that. That's a different story. So the point is that at this point, testing the 192 would be extremely healthy. It would be like this. Let me just clean this chart out again. Show everyone. It would be beautiful. I'll make a ton of money on the hedges, get the heck out of Dodge. It's old Western term from saying get out of town on the short side, wait for a sharp bounce up here, and back towards 194, see whether or not we can violate this. Because remember, if we had taken out this gap, this orange, yellowish orange band here, I'd be out of my hedges, period. Because that means the market is going to really rip. Didn't do that. And I'm going to show you a close picture as to where the tails are. Lots of little tails. That means they're selling. And at that point, let's say, for example, if it takes that out, then I still stick to my fact that we're going to hit the 200 level. After we decimate the 50-day moving average, downward sloping 50-day moving average, we decimate the downward sloping 34-day moving average, and we complete this pattern right there. I've shown this before. Sorry, I'm showing this again. That cup pattern is completed. It will happen. Now let's take a look at some internals. The vortex indicator, which is a trend indicator, is not telling me anything. It's going flat. The stochastics, in the meantime, are somewhat positive on the hourly chart. In non-volatile environments, I would be hugely positive. Say, wow, look at this. This is fantastic. We have a rounded bottom, and this is good. But in a volatile environment that we're going through, with Janet Yellen speaking after the market tomorrow, with all kinds of stuff going on, economic numbers being shot at us from China, from Japan, Germany going through their massive collapse. Keep in mind, that's a global margin call. Volkswagen is one of the biggest components of the German DAX. It's not a joke. I don't drive a Volkswagen. I love German cars, high-performing German cars, but I don't drive a Volkswagen. I don't really care about Volkswagen, but why should you care about it? You should care about it because it is a big component, and it lost 33% of its value and gained a little bit today. So don't you think there are some institutional margin calls that need to be settled? Huge amounts of European fund managers have Volkswagen, just the way a lot of American fund managers, mutual fund managers, as well as pension fund managers have GM and Chrysler and Ford in their books as core positions. A good number of European fund managers have Volkswagen as their core position. They're getting hurt. They have to meet those big sellouts. They're not abandoning Volkswagen just because they lied on their emission control and their diesel engines. Doesn't mean all of a sudden their sales are going to slump and nobody's ever going to touch a VW. But that's the market. So at this point, I believe that there is some resistance here because I look at the stochastic the same way I look at the charts, right at this level. From this point, I think there's another bottom to be made. And then we get up and get overbought again. So how does it play out on the actual charts and for your trades that you're doing in individual stocks? I think we come down here and then we make a sharp move up. That's it. So the long and short is that's really the picture. Now, in the meantime, there's a wide channel. I've shown you. This is my level that I'm looking for the market to go over the very near term. And then if things really break apart, then we're going to come down and test this 186 level. So you gotta have hedges and you gotta react quick and move if things really turn ugly below 190. And it doesn't matter what long trades you have, you gotta protect it and not rely on hope and opium. Hopefully nobody's taking opium, but hopium. Um, you know, don't just rely on that. There is no time to rely on hope here. This is a volatility-driven market, which is really not insane. It's structured volatility. So you have to, I don't know how people can react to it, especially if they're not watching the screens. I wish I could give an easy answer. People say, hey, it's difficult for me to do this and that. In that case, don't bother trading the market intraday. Buy things out in November. Buy things out in December. Based on the theory that the markets are going to rebound, and as they're basing here. I'm going to show some dailies and weeklies to prove that. So that's one way you do it. Somebody told me today this market is completely decimated. Then I said, yeah, because you're never taking the good trades and you're all sitting around and holding on to your losing trades. Who's to blame? I did a bunch of nice up trades this morning. Amazon was a clear winner. Just all you need is 1 or 2 trades. And then maybe stop trading for the day. Amazon gave like 2 chances to do what it needed to do. I played the big one in the morning. When calls go from 4 to 6, that's 50% return for an hour's work. So, just pointing out some very, the real facts. If you're looking to trade the market on a short-term intraday basis, better get glued to the screens. Don't be looking at your silly iPhone, Well, I'm an iPhone convert, so, I shouldn't say silly. And say, oh my God, let's see what tweet I'm getting and this and that. No, that's stupid. Got to have screens where you're watching your own, watching what's going on, because things are changing quite rapidly. You know that. I know that. So saying all that, looking at this, I'm zooming in here. So look what we closed at. Now, I'm not going to go deep into candle reading, but in my opinion, given the backdrop, which is extreme volatility, I'm going to call it VOLAT, volat. Sounds like Borat, right? So volat. That this are all running tails. See that? That means every time it gets up, it sells. Just because it closed something like this doesn't mean we're not going to have futures up 50, 100 points tomorrow and my puts get blasted, but I also hedge with S&P calls, so they'll do well. And the Facebooks and stuff that are being carried along. But what I'm saying is that this is not necessarily a very powerful picture. Let's take a look at it on a 30-minute basis. Okay, so on a 30-minute basis, kind of a similar story. Now, 30 minutes doesn't mean it's 30 minutes. It simply means you're getting a closer look at the action. It's like when you're driving by the highway and there's an accident like 2 miles ahead and all the cop cars and stuff are there and you're like slowing down. That's what people do, right? Just to see what's going on. Well, if you're 2 feet away, then obviously you're going to see the, whatever happened. So zooming in, that's pretty much what the charts try to tell me. So here we have, again, the bottom of the falling wedge is the same, the 191 level. We have a pinched Bollinger. Look at this, bottleneck. I hope everyone can see that. Right there, the bottleneck. The lower end of the bottleneck is around 192 and change. Upper end of the bottleneck is basically right here on the lower edge of this orange line, which by now you guys should all know is a gap. This is the gap. So this is the lower end of the gap. It's actually quite easy. I actually explained all this to my son. He's 16 and a half. He has no desire to stock trade or anything. And he's a great math guy. But even he could understand that. So here we have a situation where it's kind of neutral. But look what's happening here on the stochastics. The stochastics didn't give me any idea that things were that bullish going into tomorrow morning. But what do I know? You have economic numbers coming out from Japan, from China this evening, 9 o'clock, 10 o'clock, all kinds of stuff. So saying all that, wouldn't be surprised if we get down to oversold level again, first part of the day, before we make a bounce. I believe we get a bounce on the latter part of the day on Thursday, because the market's going to be fearful. The shorts are going to be somewhat fearful that Janet Yellen's speech at 5 p.m. after the market is not going to be hurtful or damaging to the markets. How about that? So if we're going to have a little retracement, then we could very well either come here or drop rather quickly, shake all the longs out at that 191 level, in which case I'll be a very heavy buyer. And then for Friday, we could be looking at this. So that's your very short-term picture. Let's take a look at, I'm going to pull in a picture of the E-minis, which are the S&P futures. Let me remind you something about futures. A lot of these stochastic resets and all these overbought, oversold conditions, I would say a good 90% of them are pretty much done during, overnight hours. Futures were up big pre-market. Showed that earlier on today. At Tuesday, look what they were. The futures were up at 5 in the morning. They were at 1943. Looked fantastic. I thought my calls would be ballistic, S&P calls. Didn't work like that, right? Because what happened during the day? You got two large candles. Look at this. Red, just blew everything down. Then we had a little bit of a candle here. This is a 4-hour chart. The stochastics are mixed to positive. You can see that right there. But at the same time, when you look at the overall picture, I'm trying to draw a parallel, channel here. It's still showing me 1900 to 1906. A complete breakout over 1955. That's about 120 points on the Dow on the upside. Would bring us up to 1982, which is also the bullish scenario or the bullish probability. This is the 200-day moving average, the yellow line. So I would be, again, I believe that this level here, I might be wrong before, nothing wrong, right? There's nothing wrong being wrong, because you always have, you always have your longs to play along with. That a test of the 1905, 1906 and the acceleration band, and then this very clearly defined line right there, the red line that I drew. Okay, right here at 1900. Look at that. This is the lows from September 1st. A slightly higher low on September 4th. And then this. So this is the band we're traveling in. So given the shape of the Bollingers, there are many different ways to read charts, okay? Chart reading is like art appreciation. Many of you who collect art or love going to museums to see art, it's not a mechanical form. So these Bollingers are still kind of trending down, as you can see. The shape. I'm talking about the shape right there. So if that's the case, if you're going with the Bollingers and the acceleration bands, this acceleration band, then you're still looking at this level. That's the reason for the hedge. In the meantime, this is starting to shape up, and that's good. Let me show you a picture of the daily. The good news is that we had a reversal candle today on the daily, and we are starting to base. So whatever sell-off or whatever minimal pullback that we get, they need to be bought. This was a nice, it was down to 0. I would like to see it at 0. What I like maybe doesn't happen. So on the daily, and this is the good news for longs, we are in a basing pattern, despite the fact that levels are saying that we might hit 1900. 1900 simply means a quick 150 point down before we bounce. Or maybe it's already bounced today. I don't know. And this is what I'm watching. This is a positive sign here. Doesn't mean it can go like this and then do this. Stochastics are the lifeblood of your trades. You don't know how to read them? Learn how to read them. Sign up for the coaching sessions. I'll teach people, and I've taught people how to read them. Right or wrong, they have played on them, and many of you have done extremely well playing that. Instead of just a guessing game like, what's going to happen. The market is still on a downtrend. Look at the 50-day moving average. Look at the 34-day moving average. They're all sloping down. We have huge resistance at these levels. This was the Fed fake out. I explained to people in the coaching session last night that the reason I didn't go completely bearish on this spinning top reversal hammers, why it's called reversal hammer, because the head of the hammer is down here, is because it was still an inside day. What does that mean? Read up on it. And it means that the bullish candle from the previous day, it was still within the body of that candle. You can see that. So that stopped me from going like, hugely negative. So on the dailies, we are starting to turn somewhat. Okay. Let's take a look at the weeklies. Now remember, the futures E-minis are going to look a little bit different than when you're looking at the overall picture on the S&P. When you look at the S&P 500, we are capped by the Darvas box. Green line up here, this box. I don't make that up. That's an automatically generated box. This is not necessarily negative, but neither is it necessarily positive. This is the weekly chart. You definitively have a solid low here on the where we hit, low 1800s. And there is a possibility we hit low 1800s again. But overall, the downtrend is still intact. Can bounce up and get towards 2000. I've shown that, 1990, 2000. But we need this to turn. Okay, SPX. On the weekly, not looking good. Looks like a test of on the actual S&P 500. Looks like a test of 1866 is very likely. Look at this way it's going. This is still trending down. You can do this yourself. You don't need me. Okay? It's trending down. It can turn up. The machines can turn this up within an hour. But that means we have to break out over 1991 and not look back. Okay? In that case, those lines will turn and you get a nice cup moving up towards the 2060 level, which I think is still a possibility. And fail there. If we are truly going in a bear market, we're going to fail there, move down hard. All kinds of funny stuff will happen. Let me just quickly show you guys a picture of the VIX, and then I'm going to take a question or two because I have my son's PTA meeting to go at the school because I am the glorious president of the Parents Teachers Association. So I'm going to tell them to all learn coding and learn math and not sit around and listen to Jay-Z. right? So let's take a look at the VIX. So looking at the VIX on an hourly basis, we do have a running tail or reversal candle. That's negative. That's positive for the markets, right? It's inverse to the markets. However, let's take a closer look. The closer look on this, we went to 23, we went to 22. Doesn't really rock my boat. If we had closed below 21, I know we'd have a blast up tomorrow. Looking at the 15-minute chart, same thing. We had a reversal candle off the upper Bollinger, and right now we are right there in the middle. So the VIX is harder to read on the stochastics and all that because it is a derivative, just like the UVXY. So you're going to see movements which are rather rapid and not always that easy to read. Let's take a look at the daily. This is saying caution because the daily VIX has not turned the corner. It is still bouncing off the 34-day moving average. It is a doji formation right there, like the cross. And it says, it's telling me it wants to go to 26. If the VIX rises 4 points, we are going to hit 16,000 on the Dow fast. That's on the daily. So what I'm showing you is some pretty advanced stuff on all the different signals that's coming out of the market. This is telling me that it is on the way to getting overbought up here. The minute the VIX gets on the stochastics up to 80 and stuff, well, forget it. You got to short the market. I'm sorry, you got to go long the market and hard and short the VIX. But this is telling me on the daily that it's still trending up. It's very clear. Trending up is 26. I'm basing it on the upper Darvas. This is the Darvas box here, and I hope you guys are using it. Acceleration band is still saying 35. Wow. If we move to 35 on the VIX, and believe me, the VIX can move, right? We've seen it. Then we are going to drop 600 points on the Dow fast. So that's it. So I'm just trying to tell you that a lot of mixed signals. You got to play what you see. But more importantly, if you're going to trade 3-4 points, make 50% on your money in 20, 30, 50 minutes, then you got to be stuck at the screens. You're looking for swings out there where you don't want to care about daily things, daily intraday volatility. Go out there, buy the late Octobers, buy the November calls. These Facebooks and the Apples and even Netflix, even though it's been weak lately, Amazon, they're going higher by the end of the year. There's no question in my mind because I think the earnings are going to be strong. The U.S. economy is gaining strength, and these stocks are good to go. But if you're going to play specialized situations based on intraday volatility, then you got to be stuck to the screens. Big announcement. I am almost finalizing the SMS text alert for Platinum members. They're going to get select text alerts, not everything, select text alerts. And if people are open to getting them, then just upgrade your account to the Platinum membership. It costs a bit to get the text alert and stuff sent out, and I am going to go ahead and fully implement it. I've taken full control of it, and it's going to be fantastic. You get text alerts on trades. I'm trying to see if I can attach a chart to it or not, but text alerts are text alerts, right? Let me see what I can do. But in the meantime, starting, I believe, this Monday, I will have the full list of people who are Platinum members, and they will be receiving the text alerts on an intraday basis, probably 5 or 6 during the day. Don't have to be glued to the screens. If anyone wants to take advantage of it, then feel free to upgrade your account for a limited time if you wish to see how they work, just to test it out. Go into your account on the website and move it up to Platinum, and check it out for a month or two and see what happens. Here's a picture of the Dow Jones Industrial Average on an hourly basis, which is still. You can see here a lot of lines drawn, but they're all. This is the channel. We hit that channel. We failed. We are starting to base here. You can see that there's a double bottom on the stochastics. The vortex indicator is telling me nothing right now, and Right now, the lower end of the Dow Jones is 11,172. I mentioned that earlier. I also mentioned the 16,000 level, and all that is a very strong possibility. These are volatility charts. So again, you have the 34 and the 50. If you move up to, let's say, 200 points, I still believe that this would be a beautiful buying opportunity like it was there. Will the market make it easy for us? No, but patience. And then once it gets here, you're going to see a strong bounce, and that's worth some real serious money. Right now, it's a mixed signal. That's a Dow Jones for you that a lot of people watch. So that's it. The Canadian numbers for texting, yes, we are. I'm setting it up so the Canadian numbers can also get the texting. Okay, let's see questions. All right, so I got to run. Quick one on Russell. I know somebody is Mars 99 is in Russell 2000. So let me just go to the Russell 2000 here. It allows me to go there. The Russell 2000 is in a bearish pattern right now. Okay. Russell 2000 moves on a completely different set of factors, primarily commodities and oil and gold and stuff, right? So it doesn't move like the S&P. So when you look at this, it's negative. Now remember, this is a daily chart. So on a daily chart, the Russell 2000 would be a screaming buy at around the 1110, if not the 1120 level. Getting down here during the flash crash 1100, I'll be a buyer. But till it gets there, the closest thing I can say is 1130. 10 points from here would be a good move up towards 1160. So that's the Russell 2000. I did post that chart earlier. The vortex indicators are negative. The stochastics are negative. And this chart overall does not bring joy, but therein lies the opportunity. So getting all the lines out here on the Russell 2000, if you are following the channels, and I've been dead right on these channels, I said buy here, it got into the channel, guess where it hit? It hit exactly the upper end of the channel and the downward sloping 50-day moving average right there. See that? Guess where it failed again? Right at that downward sloping 34-day moving average. So given without over analyzing it, a nice move down here to the bottom of the channel would be your buy zone, in my opinion. And by that time, we get pretty oversold. That's a picture of your Russell 2000 right there. I've been staying away from the Russells because I've had a lot of success in the S&P. I am putting together a course that I'm going to conduct myself on the S&P, trading the S&Ps on an intraday, intra-week basis. And it will be a paid course, minimal, of course, just like all my other coaching courses. And I will also include live trading, so you can actually see doing. I'm not going to show you my numbers, just because I'm playing around with $1 million. I'm just kidding. The point is, but you will see live, like, okay, this is the way it's moving. This is what the spreads are, where you can buy it, and you can mimic it. So again, I'm not here running anyone's book. I am not in the business of mirroring other people, have other people mirror the trades. I don't believe in all that stuff. And there's also a big liability, legal liability on that stuff. So the point is that I'll be getting that together for October, and I've got a lot of interest on that so far. And anyone else who's interested, just email me at frank.r@clueless8.com, and I'll be happy to include you on the list. There will be general courses. There'll probably be a 3-part course. There will be the initial introduction, the whole works. I'm also looking to include my friend KG Trading, if anyone's interested in learning about futures trading. So that could be part of that package, just so you guys know that. Because KG is a terrific futures trader. They think differently, they act differently, and it could be something very useful to a lot of people. I know futures trading. I have some knowledge about it, not extensive, but I track futures all the time, as you guys all know. So this could be a real big plus for people who are looking to learn how to manage their books. So that's it for now. I do have to run because at 5:35 I have to look good and run out to the school to conduct the parents-teachers meeting. I hope this was helpful. I'll put this up on the Clueless8 YouTube website. I'm sorry, Clueless8 YouTube channel for other people to review. Thank you for listening. Would love to get a lot more referrals. And do sign up for the group coaching sessions and the SPX trading course that I'm putting together. Thank you for listening. Good night.